Hey guys, Toby Mathis here, and today we're going to go over the One Big Beautiful Bill Act. So the new law that got passed into existence and into law on, I believe it was July 4th, right? Right, Scott?
That's right. Yeah, yeah. We had a happy patriotic day.
Yeah, and Scott Estill is a former lead trial attorney with the IRS and a tax attorney. Me, I'm just a plain old tax attorney, and we're going to go over these things in rapid fire because there's so much here. I think we're talking about 1,000-page bill with a lot of changes. And you're hearing about like the top 20, but there's hundreds of changes. And so we're just going to dive into it. And Scott, I'm going to hand it to you so we can just start going through the personal uh, tax law changes and how they apply to individuals. Let's start there.
Yeah, there are just so many changes here, and like Toby mentioned, there's a 1,000-page bill, which I have to admit, Toby read the entire thing word for word, but I didn't read the whole thing. But there are a lot of different provisions, and the reason we have this tax bill is because a lot of the tax law changes that happened back in 2018, I guess it was, are expiring. And so we either go back to where we were in 2017 or we forge a new path forward. And what the Republican Party did basically is pass this one big, beautiful tax bill. And so, I think looking at the individual side, let's start with the individual tax rates. That these are going to remain the same as far as where they were the last few years. They were going to revert back, and really the big difference here is for the very upper earners here, the high income earners, where they're currently taxed at 37%, would have gone to 39.6%, but now it's been back down. So the top tax bracket remains at 37%, and then we also have these brackets indexed for inflation so that you don't, make more money as far as inflation goes, but have to pay more tax. And so the brackets will change every year, indexed for inflation.
Yeah, the idea is that bracket creep happens that as inflation pushes your income up, it pushes you into a higher tax bracket. So at least, just in a big sense, you had the 15% went down to the 12% tax bracket, 25 went to 22, 28 went to 24, the 33 went to 32, the 39.6 went to 37. And all this is doing is saying now it's not going to revert back. We're just extending it out and it's permanent. So
Correct.
we're not going to be dealing with this again unless Congress decides to change the tax brackets. But it's not going to automatically sunset like we had under the Tax Cut and Jobs Act. And what they really do is they just made the changes that they made under the 2017 Tax Cut and Jobs Act permanent. And so this is one of those changes that was permanent. What are some others, Scott?
Well, we've got a standard deduction too that was set to expire at the end of this year. And this is really important when we look at who itemizes their deductions versus who takes the standard deduction. And about 90% of all Americans use the standard deduction last year. And so I would anticipate that would stay pretty similar. But what this means is that if you're a single individual this year to 2025, you get a deduction of $15,750. And we double that if you're married and you file joint. So a married couple would get 31,500. And so basically what you do is you just add up all of your charitable donations and your mortgage interest, and we'll talk about some of the state and local taxes. But you add all this up, and if you're single and it comes out to more than 15 grand, you itemize. If it comes out to 10,000, you take the 15,750. And so these were set to go back about 50%. They would have been cut in half without making this standard deduction permanent.
Yeah, that would have been extremely painful. And that's for people who do not itemize. For people who do itemize, there are also some pretty significant changes here, and not the least of which is what the salt deduction.
Yeah, and I think that's where so much of the talk was, over the negotiations between the House Republicans and the Senate Republicans to get a bill to the president, was what are we going to do with SALT? And SALT stands for state and local taxes, so SALT, and that's been set at $10,000. And kind of to give you an example of this. I can almost take Toby and I here and say, okay, each of us makes 250,000 a year. I live in a state that has an income tax, and Toby doesn't. And so I'm going to pay about 10,000 bucks to Colorado on that 250K, where Toby wouldn't have to pay that to Nevada because there's no income tax. And so what Congress did is they increased the SALT cap from $10,000 up to $40,000. And so that includes your state income taxes, local income taxes, your personal residence, whatever your property taxes are. Some states you get levied car taxes or the vehicle taxes. So all of that gets lumped in to this SALT, and as long as it stays under 40 grand, we're good to go. I think something. Toby and I were talking about this before, and I think we could do a pretty long webinar or something just on some of these SALT deductions, because there's a lot of play in them as to how we can use them to best benefit us. Toby, I noticed in your business section that there was some pass-through taxes with respect to SALT. Um,
Yeah.
do you recall like what those were, as far as how do we get around this? I mean, what about if I pay $50,000 to the state of California in income taxes? The cap says 40,000, and I lose 10,000, and then maybe I have an S corp or an LLC or something that flows through. Is that all included in the SALT? And that was a really big issue to have to get through.
It's a huge issue for people that have pass-through businesses, and under the one big beautiful bill, you can actually deduct it on the business level if the business elects to pay the state taxes rather than pass through the income to the individual. So if the state goes ahead and pays let's say it's $50,000 of state and local taxes on the business side, and there was, let's say it was 500,000 and it chose to pay 50,000, it would deduct the 50,000. So you'd end up with $450,000 that would pass through to the individual. And now they're no longer deducting any state and local taxes because the business already paid it on their behalf, and they could take the standard deduction and be very, very happy. If the business doesn't do that, then the whole 500,000 would pass through, and let's say you owed 50,000 of it. Well, you're limited to deduct up to $40,000. There's a phase out to the extent that your modified adjusted gross income goes above $500,000. And I don't want to get too into the weeds, but under this example, you wouldn't have that. Let's say it was married filing jointly taxpayer, and they made $500,000, and they had to pay $50,000 in state and local taxes. They would be able to write off 40,000 of it because that's the cap. When you phase out, let's say you make $1,000,000 and you phase out completely out of that 40 to 30 to 20 to 10, the lowest amount you get as a deduction, if you're itemizing, is $10,000 of state and local taxes. That's your cap. It doesn't mean you automatically get to write it off. If you didn't pay that much on state and local taxes, you can only write off what you actually paid. But it used to be just flat $10,000 state and local tax. Now they've added it up to 40,000 with a phase out, and they codified the business deduction where you can still write it off. The business can elect to do that. I think there's 30 states right now that have laws that say you can elect to pay the state tax at the entity level. And I would say talk to your accountant, because I imagine some other states are going to jump on board now that the one big beautiful bill is passed, and they're going to say, hey, we should do that too, so that the people that are paying it at the entity level as a partnership or as a corporation, S corp, actually do not get dinged and end up not getting the benefit of the taxes that they paid as a deduction.
Yeah, absolutely, and I think that's really key here, and it'll go into my next one as well, but my next point as well. But you start looking at that, and it's like either way, you're going to pay that 50,000 in tax. The question is, are you going to get a tax deduction for it?
Yep.
And it's kind of the same thing that I look at as far as like the miscellaneous itemized deductions, which were in play as far as your legal and professional dues, fees that you happen to pay, any sort of financial planning, safe deposit boxes, all that stuff was eliminated. Um, and is now made permanent. So we don't get to claim these miscellaneous itemized deductions. But something that a lot of people miss is that, if you're paying legal fees or professional fees and they can relate to your business or maybe relate to your real estate holdings or whatever, those now become deductible, which if we call them these quote unquote miscellaneous itemized deductions, not going to be deductible anymore. So make sure you have a good plan in place that if the personal side, which is what we're talking about now, says you can't deduct it, come back with the next question, right? Is there a way that maybe I can't deduct it, but my business or my rental properties can?
And I think you're making a good point. The miscellaneous itemized deductions was made permanent. It's gone. You can't write off miscellaneous itemized deductions. And there's all sorts of things that get wrapped in there, casualty losses and theft and getting swindled. There's some workarounds on the Ponzi's and when there's federal crime committed and things like that. But there's a whole bunch that aren't there, and you just hit some big ones: legal fees, um, financial costs for like services, have somebody manage your account, tax prep, and things like that. And if you're one of those people that pays like $2,000 to your accountant and they do your personal and a S corp return, the S corp you want to make sure that you're writing off that on the corporation and not you individually, because you won't get a deduction for it. But I don't, I also want to emphasize that this is if you are itemizing, right? So you still get the standard deduction no matter what. And if you phase out because of SALT, miscellaneous itemized deductions, and things like that, and I'm sure there's more that we'll be talking about, you could always take the standard deduction, right? So, like, if that's better for you, and some of these are not as valuable, then you can always go that route. But again, a lot of high income folks, they have lots of state and local taxes. They have their real estate taxes that they're paying on their individual residence. They have charitable donations that they're making. They have mortgage interest deduction that they want to be able to write off, and they have medical expenses that exceed the floor, and they're itemizing. And under those circumstances, you got to look at it critically. Don't just assume I get to write it off because it's an expense that I used to be able to deduct. You got to start looking at it, and I'm sure Scott's going to go over a few more where there's some caps and there's some limits and there's some things that the one big beautiful bill put in place to appease a section of society where they're trying to make it, again, they want to tax the rich. And so if you're somebody who's going to be rich, then you might want to get with your accountant to make sure you're not caught by one of these.
Yeah, I think that's a really good point, and I think that this year is going to be one of the most crucial years for tax planning because, as you'll see, there's some of the provisions and some instances where you may need to act in 2025 to preserve certain deductions, and other ones where you might want to wait it out. But the issue with the standard deduction versus the itemized, though, we can start looking at the bunching of expenses. And I think that's something that we've discussed before and we'll probably hit again. But in
Mm-hmm.
the sense that if you're typically around $30,000 of itemized deductions, maybe you increase your charity this year to be able to itemize, or maybe you push it off till next year and bunch them to take the itemized deductions one year, standard deduction some other year. So you don't have to be consistent in that. You can switch back and forth. And if you've got hundreds of thousands of dollars of deductions, that won't matter. But if you're real close to the threshold, it certainly could. And
Yeah.
a couple other points as far as the itemized deductions go. There is a cap on those this year, and that's something that's new. So it's going to start actually next year in 2026, but it only affects those in the top tax bracket. So if you're in the 37% tax bracket now, and presumably if you're going to be in that next year, understand that you're going to lose 2% of all of your itemized deductions, in the sense that, if you had $100 charitable donation, you would have gotten a $37 deduction before. Now you get $35. So you're losing that 2%. And I think it's just a way, like Toby just mentioned, that we're going to tax the rich, whatever that may be, a little bit more. So but it's something that I don't think a lot of us have to really worry about because the 37% bracket kicks in at what is it, 600 and some thousand, I think, for singles and 750 or something. Again, I'm throwing rough numbers out, but you have to have a fairly decent taxable income to get into that. Um, as far as the personal exemptions go, so this is where we would have been able to bring back, and if you have two kids and you're married, you get four deductions, and they were each worth 4 grand or 5 grand or whatever it would have been. Those are eliminated, and what the Republican Party did here is, in keeping those eliminated, is they kept the standard deduction higher, so that in effect took a little bit of the blow away from the personal exemptions.
And that was, I mean, that was already gone. It was going to come back in 2026, and all they did is they said permanently gone, no personal exemption. Yep, standard deduction is going to be much higher, and it's indexed for inflation, so it's going to continue to go on unless Congress takes action and eliminates it at some point in the future or modifies it at some point in the future. As it is today, that's permanent as well. But they did go back and, again, trying to appease people. But you remember they were like, hey, no tax on Social Security. They did do some interesting things there. Do you want to hit on that?
Well, yeah, they did quite a bit as far as like the Social Security goes, as far as the tips, overtime, income, that sort of stuff. Let me see which page I had the.
The extra deduction for seniors, which,
Oh, yeah, yeah, yeah.
yeah,
Let's do that. So the seniors here, and senior means turning 65 in the year. So if I'm 65 on December 30th, I'm 65 for the whole year. Well, what does that get us? Well, it gets us an extra $6,000 deduction for each of the taxpayers who's over 65. So if I'm married, filing joint, we're both 66, we would get a $12,000 deduction here. It's not a credit, but it reduces our taxable income by the 6 or 12 grand, whatever it happens to be. Um, Modified adjusted gross income, we have issues here as far as phase outs go. So if your income goes over that 75,000 or double that if you're married, filing joint, you can have the deduction reduced or the senior deduction reduced. But it's something that you can take even if you don't itemize.
yeah,
So
it,
to me,
it's
it's it's a huge win once you're up at age 65.
and it's 6% per dollar over those thresholds. So single is 75, married is what, 150, and
Yeah, the
anything above
150.
that it starts to phase out. But here's the interesting thing here: this is temporary. So this is only through tax years 2028. So it has to be before January 1st of 2029. So it's going forward. I do believe, is it effective? I think it's effective this year in 2025, or is it 2026?
I believe it's starting in 2026. Um, now I'm not sure about that. But it would be definitely something to be looking at
I'll look it up
as
real
far as
quick.
what the seniors go. Yeah, I'm not sure what they did as far as the senior deduction. But when Toby mentions, he says, well, it's permanent or temporary. So the deductions for seniors has to be done through 2028 and January 1 of 2029. We're going to lose this deduction. Understand, though, that there's nothing in the tax code that is permanent, meaning that this particular Congress next week could change something that we say is permanent. So it just means that it won't be coming up for a vote anytime soon, right? That as long as Congress doesn't want to vote on the issue, um, as far as like the personal exemptions, then they don't have to and nothing will change.
It's interesting, Scott. I'm just going to say this. So the senior deduction was lumped in the provision. I think it's section uh, 70103, but they amended that. That's where they got rid of the personal exemption, and they basically just went there and struck language that said before January 1st, 2026, and just eliminated that. And then they added in the case of a taxable year beginning before January 1st, 2029, which in English means 2028, 2027, 2026, 2025, you get a deduction in amount equal to $6,000 for each qualified individual. So technically, it starts right away.
Yeah.
I
Okay.
don't see a limitation on it.
Good, good. Yeah, that was one thing I didn't look up. So, and that's the problem with these is that it's not consistent, right? That we can't say, well, they all expire here or they all begin here. There's a very piecemeal component to this tax bill, and so it doesn't necessarily all line up. Um,
Yeah.
a
And
couple of
this is
other,
where I'll do a caveat, Scott. I'll just say, like, we're
yeah,
talking
yeah,
about
yeah,
these things that just came out, and a lot of people are going to be talking about it. Um, and you're always going to, there's going to be some interpretation by the IRS, and you're going to need to work with a tax professional to take advantage of these. I don't want you to think that you can just magically wave a wand and it's going to be added. There's going to be software companies that are adding things in, et cetera. There's going to be some flushing out, just like there was with the CARES Act and in all the interpretation that goes on. It can take years sometimes. But just know that if you are somebody who's turned 65 this year, 22, from this point forward, if this year you turn 65, there's a good chance you're entitled to these things unless you're making well over the modified adjusted gross income of, which is really for people that don't have foreign income. It just means adjusted gross income of 75,000 if you're single, married, if you're over 150. But it doesn't just eliminate it; it phases out. So you're still going to be entitled to something. So that's where you get with your accountant and start doing some planning.
yeah, yeah. And this, like I mentioned before, this is a really good tax bill for tax professionals because there's a lot in it. And pretty much anything that you're doing, whether you're a W-2 employee, business owner, real estate investor, retired, whatever, there is something that is going to affect what you're doing. And so I think definitely getting with your professional for sure this year. And if you don't have one, you need to get one because this stuff is pretty complicated.
Let's
Um, it,
let's hit on two things that you'd mentioned, which is the tax on tips and the tax on the overtime, where you all heard President Trump saying, "Hey, we're going to eliminate tax on tips and overtime is going to be great," and everybody says, "Well, I'm just going to get paid in overtime, or I'm just going to get paid in tips," or all this ridiculousness. What ultimately came out, and I'll ask you, Scott, because these are temporary again. These are for 2025, 2026, 2027, 2028. I think they're done. They're not
yeah,
going to be around in 2029. So these are temporary taxes. What did they end up doing?
right. So again, temporary, right? So in 2029, January 1, we go back to there is tax on tips and there is tax on overtime. But I think if we just leave it there, if we just say, okay, there's no tax on tips, you go around thinking, great, I can make $50,000, $100,000 a year on tips, and I don't have to pay any tax. It's like, wow, that's great. That's also not the law, unfortunately. So what Congress did here is they limited the amount of tips that you can avoid tax on, and the same for overtime. So when we look at tips, it's a deduction of up to 25,000 per person per year in qualifying industries. So those people that you normally think, a bartender, a waiter, a waitress, whatever, server, something like that, where they're really working on tips, they get to deduct up to 25,000. So what would happen here is, let's say that they made $25,000 in W-2 wages and they made 25,000 in tips, they're still going to get a W-2 for the 50,000, okay, the full amount. And all of that is going to be taxed for employment tax purposes. But when they then go to file their income tax, they get to deduct the 25,000. And you could see, if your tips were 50,000, you could only deduct half of that. So the other half would not be a deduction. So if you look at this, if I say, okay, I'm that guy that is going to make exactly $25,000 in tips, what what do I, what's my savings? Well, it's going to depend on my tax bracket, but either way, that 25% or excuse me, 25,000 in tips is going to be taxed for employment taxes. So you've still got a $1,900 bill there that is going to be withheld.
And I want to put two caveats on here that I don't think get enough discussion. Number one, these phase out. So if you're modified adjusted gross income, I think they did a higher level of 150 for single and 300,000 for married filing jointly on this. You phase out, I think it's 10% for every dollar over those amounts. You lose this deduction. And it is a deduction. It's not a tax credit. It's not like you magically, like Scott just says, it's not like you don't get to report it. You report it and you take a deduction. But the other big one is your state may not agree. Your state may say, yeah, I'm still going to tax you on it. So even though you're saying no tax on tips, so let's say you're a service worker, and by the way, this is limited to industries that customarily receive tips. And it is limited in the way that you're calculating your overtime as well. Like this isn't a thing where you get to reclassify stuff. It is like for service industry. Let's think of that. People that customarily like the Starbucks barista. Just because you're getting that deduction federally does not mean your state's going to go along with it. So we're going to have to wait and see what the states do. But some states may say, no, we don't recognize it. And
Yeah,
so you're
yeah.
still paying state income tax on the money that you're getting a deduction federally, but you may not get it statewise.
Right. I mean, if you are in one of the four, what is it, 43 or whatever the number of states are that have a state income tax, and I'm in one of those in Colorado,
Mm-hmm.
yeah, you definitely need to take a look at it. As far as is Colorado and a lot of the other states too, they have certain add back forms so that if your taxable income for federal purposes is 100,000, they may add back certain things, and that's where this tips income could come back in. So Colorado could say, no, you don't get to deduct that. So whatever you claims as a deduction on your federal return, we're not going to include as income on your state return. And it's the same thing for the overtime too, where you think, oh great, I get all this overtime and I don't have to pay tax on it. Well, yeah, it's good, but it's not quite that good. Same issues here. Employment taxes due. Toby's caveat about the taxable for state still applies. So we don't know what the states are going to do, and maybe Illinois says yes and California says no or something. So we're going to get a very mixed bag, I think, as far as the state taxes go. But the overtime's a little different because it's half of what the tips are. So overtime 12,500 if I'm single, 25,000 if I'm joint. As far as do I have to pay tax on that? Again, federal taxes only, maybe the state as well. We'll see. But this one, like Toby mentioned, expires at the end of 2028. So in 2029, either it's gone or Congress has done something to continue it. And we'll just have to wait. So we can plan for the next 3 years, but we don't know what's going to happen starting in 2029.
You just mentioned something that I want to make sure we're emphasizing too. It's $25,000 per individual on the tax on tips deduction. On the overtime deduction, it's 12,500 for a single and 25,000 for married. So it's half. And I've seen that goofed up. Even in my brain, I still almost put them on parity, but it's not. There's a pretty significant difference.
Yeah,
But let's dive
there
into
is.
some. Let's dive into some of the credits. I know because we'll be here till midnight.
Yeah, yeah. Some of the credits, I mean, there's a lot of differences in the credits. I just want to go back one quick point, though, is that you are allowed to claim the deduction for your tax on tips and tax on overtime in the same year. So it is possible that you could get 25,000 and 12,500 if you have both of those. But again,
Yeah.
they are phased out, and there's also phase outs on a lot of the credits too. That different rules come in, but remember the difference, though, right, between a credit and a deduction is that your credit reduces your taxes dollar for dollar, where a deduction is only worth whatever your tax bracket is. So we really like the credits. So there's an adoption tax credit, there's a child tax credit, and let's look at that. So child tax credit. So let's say I have a 10-year-old at home. Um, this tax credit would have dropped down to $1,000 next year if it wasn't changed, but it's made permanent. It goes up to $2,200. You get this indexing for inflation. And one of the nice things about this credit is that it does provide a provision to be refundable. So what does that mean? Well, let's say that I don't have any income taxes that I'm going to owe for this year, and I qualify for this child tax credit. I can get up to $1,700 of that refunded, and not all credits work that way.
Means they write you a check. I don't owe
Absolutely.
any taxes, but I got this refundable tax credit, and the government sends you a check for $1,700. It's pretty
No.
significant.
Yeah, really, can you get a better result from taxes than that? Is that not owing any tax and then getting a check back from the government?
Yeah.
Child tax credit definitely works that way, and there were also changes for adoptions too. So there's an adoption tax credit that was out is out there. It's now partially refundable. I don't believe it was refundable before. The credit itself remains the same. So there's a maximum. It's a little over 17 grand per child. So that would include all of the expenses in getting the adoption set up and actually completed. So it's a pretty nice credit that's available. And certainly if you're in the position where you may be adopting a child, you definitely want to be looking at the tax implications of that because there's a lot of them.
Hmm. And it's a big one. Again, a deduction, let's say I have $1 deduction and I'm in the 20% tax bracket or paying 20% thereabouts. I would get for $1, I save 20 cents. When you get a tax credit and it's a dollar, right? You're getting a dollar and you're applying it. So when you see a tax credit, you pay specific attention. Now, both those credits are permanent. So the child tax credit, I remember JD Vance wanting it to be closer to 5,000. Some people wanted it 2,500. It was going to go back to $1,000 in 2026. So it's great. We're at 2,200. I think it's indexed for inflation, so it just keeps going up, which is great. Fantastic. We got something. Part of it's refundable. There's a phase out on that, um, on all of these, which is again meet with your accountant. But then there was one other thing that they added into this that I thought was pretty interesting, and I think it's somewhat confusing to folks because they said there's these Trump accounts where people are putting $1,000 in it. Now the government's not putting $1,000 in your account. What they're giving you is what is it, $1,000 tax credit?
Yep. Yep. The Trump accounts, I think, were interesting. Now that you mentioned those, now these are not permanent, so these expire at the end of 2028. And so basically, if you have a child that's born anytime this year, so it's retroactive to January 1st, all the way through December 31st of 2028. And so if you have a child there, you're going to get a $1,000 seed funding, kind of get it started via tax credit, and it begins next year, I believe, 2026 on that. Um, these I was looking at the Trump accounts and I was looking at them and comparing them to other type accounts, 529 plans or other education type related accounts or what have you. I like the $1,000 credit. I mean, obviously that's a good deal for any new parents. But you've got very limited financial investment opportunities here. So I believe that these have to be pegged to like the S&P 500 or different index funds. So you can't go out and self-direct these accounts or whatever. You're also allowed to throw some money in there. So you say, what's a grand? A baby born today, a grand might double a couple times in the next 18 years, and I'll have 4,000 when my kid's 18. So what, right? But you can put $5,000 of your money in each year to these accounts. Now, whether that's good for you or not is going to be an individual decision, right? I mean, maybe if let's say Toby and I each had a 10-year-old, maybe it's really good for me to do this, but it doesn't make a whole lot of difference for Toby. So we could be in different
Well,
financial situations or
you're getting
whatever,
free money, Scott. You're getting
but it's
free.
free.
You're getting
Yeah,
$1,000, so long as
absolutely.
you fund an account. Basically, it's like opening up an IRA, putting $1,000 in there, and it's not $1,000 deduction. It's literally a tax credit. So that, and then but you could put $5,000 into the account. So normally you'd be looking at it saying, "Hey, I want to put money into an account. I want a deduction." Right? So if it was an IRA, I get a deduction, and again, whatever tax bracket you're in is going to dictate what that's worth to you. So if you're in a really low tax bracket anyway, it might be worth 10 cents on the dollar. So that $5,000 is really only worth $500 as far as tax relief. Here, they're giving you $1,000. Throw $1,000 in there. You're crazy not to do it. and that's for
Absolutely.
children that are born after I think it's 1/1/25, if I'm not mistaken. But then it would be for next year. You're absolutely right. The credit comes next year as long as you put it in the account. It's kind of like when I put money into an IRA, I get the deduction. I take it next year. Um, that's what I'm looking for. So I think I have to fund the account, and then it's taxable as ordinary income when it comes out. It's just like an IRA. So you have this little window for the next 3 years or whatever it is, 4 years, 25, let's see, 26, 27, 28, right? So I got 3 years that I could be doing these. And so I'm basically getting $3,000 from the government in the form of a tax credit to go ahead and fund this account. And you're kind of crazy not to do it. It's free money. It's total market return. So it's going to be the S&P, or, it's Vanguard. I think it's VTI, SPY. There's VOO. I'm sure a bunch of those will qualify. Again, you're going to have to check with your financial advisor. I'm sure they're going to tell you which ones work. And you're just sitting back going, all right, great. I've seeded this account, and it's going to be worth a fortune when they retire.
Yeah, yeah, and the only thing that I did not like about this is that what you just mentioned, the distributions are taxed as ordinary income when they come out. So it's a little different than some of the other plans where, like a health savings account, where if you use it for medical purposes, it's not taxable for you, or 529 plans. So there's all these different plans that you can look at, depending on if it's health or education or what you're trying to save for, and then compare them to the Trump accounts. And like Toby said, if they're going to give you $1,000, take it. The question there is not whether to take it or not, but do you want to contribute five more grand every year to this account, or would you rather put it into, an HSA 529, an IRA, or something else? You could do both if you have the money. But again, that's a financial planner question. You're going to need to figure out what's best for you and your family here as far as the Trump accounts go. There was a couple of other itemized deductions that I thought were kind of interesting too, and I want to go over these. Little
Mm-hmm.
quick here. Moving expenses remains eliminated, so that was a question that I get quite a bit, unless you're moving for active duty military. So otherwise, we don't get this moving expense deduction at all. We're going to talk later about the clean energy tax incentives. So when we get to that, there's quite a bit as far as, you want to go out and buy your new Tesla or whatever. When do you need to do it? How much, what kind of credits do you get? That sort of thing. We're going to talk about that in the towards the end in the business section. But I wanted to get into charity because there
Mm-hmm.
are a couple of differences as far as the charitable contributions go. One of the things that was brought in, and this is brand new, is that people who do not itemize, so you take that $15,000 or $30,000 standard deduction, you get the opportunity now to claim $1,000 or $2,000 if you're married filing joint in charitable donation deductions. And so this is in addition to the standard deduction. And we've seen this kind of creep in before. I think like there's a current law that you can do it for teachers, and it's a $250 or something. So there has been different donations or deductions that you could claim even if you didn't itemize, but fairly unusual. So this is a real nice one for those who do not itemize and want to and make donations to charity.
Married couple that's 65, that's charitable. You're you're with standard deduction, $6,000 each, another 12,000 plus another 2,000. So your standard deduction really just pops up to, what would it be, 14,000, like
Yeah, you're right.
$45,000.
Right,
It's
you're in the mid 40s at that point, right?
yeah.
With your 30 and 12 is 42, and then whatever you get here as far as the extra 2,000. I mean, and these are like very, very easy type of deductions to prove, right? I mean, what you just said, Toby, was we're going to claim the standard deduction. Fine, I don't have to do anything for that. Just put it down on my return, and then keep copies of, how did you come up with that you gave $2,000 to charity? Do you have a canceled check to your church or to whatever it happens to be? How that's the only thing that you really need to prove here.
And you don't have to itemize to do it. That's the big one. If you are itemizing, then there are some big changes there too. I do want to hit on those because there's this new floor. Right. And this is for corporate taxpayers and individuals. We're talking about individuals right now, so we'll just focus on that. But if you're an individual and you're itemizing and you're writing off your charitable deductions, you have a floor now that you don't get back, which is 0.5%. So if you donate, let's just say $100,000, you're richy rich, you're making $1 million and you're tithing 10%, you're going to lose the first 5,000 of it. It's gone. Right. Even if you itemize and do it, you're going to itemize. And if you're at $1 million, then you're also going to hit that cap, that
Hmm.
35% cap. So you're going to lose, you're only going to get tax deduction of 30 up to 35% on the rest. Right. So it's like you run into a couple of limitations. And this is that part of the bill, the one big, beautiful bill where they said, hey, we're going to make sure that we're not giving too many tax incentives to the rich folks. They can afford to pay more. That seems to be the idea here. But that definitely hits it. And I think you had a suggestion, right? You using a donor advised fund in 2025 to avoid this because if I'm not mistaken, this is a permanent change and the floor kicks in, but it's not until next year.
Right, right. So we have the remainder of 2025 to do something about it if we need to, from a planning. So, I think yeah, it's another one where let's make the rich pay their fair share, quote unquote, right? That we're going to do that, but they did that. Congress did that in other things too, making like the mortgage interest deduction permanent now. So that's capped at $750,000.
Mm-hmm.
The good part of that, though, and so again, this is something where, if you have a mortgage that's, you buy a house today and you have a mortgage of $1 million, well, 25% of that interest is not going to be deductible. But what they did allow was the mortgage insurance premiums to be deductible. And so that was something that is kind of come and gone. I believe that went out of the law. I believe it was in 2021, but I could be mistaken on that. And so, but this is back in. So if you pay any sort of mortgage insurance premiums, that can be lumped in with the mortgage interest deduction. And as long as the debt isn't more than 750,000, you're good to deduct all the interest.
The one
Um,
thing that you got to note on the mortgage interest deduction is that it has to be for acquisition indebtedness, which could be home improvements or acquisition indebtedness. In other words, if you're going to write off and try to take it as an itemized deduction, and what you did is you pulled money out of your house to go out and go on vacation or to pay for school, you're not going to get that deduction. It has to be related to that property. And so this is where you could step on a landmine if you're not careful. You got to know that this is for you to know so that you can actually write it off. You want to be able to do it. And these are permanent. These are permanent changes. These were under the Tax Cut and Jobs Act of 2017. And what we're really doing is extending it. I believe the insurance premiums were the mortgage insurance premiums part of the Tax Cut and Jobs Act, or did they? Was that
I
something?
think they were not part of it, and then they got excluded, and now we're bringing them back in.
Okay.
Is what we're doing. So we're just basically allowing the deduction that we didn't allow for the last couple years. And and you mentioned the home improvement or acquisition costs. That's the same rules now as in place for the home equity loans. And so those any of the HELOCs or whatever you were getting as far as equity loans, 10 years ago, 15 years ago, if I wanted to go on vacation, I could take out a home equity loan and the interest would be deductible. That's not the case anymore. So, unless you can tie a home equity line of credit or a loan to your home improvement or the acquisition costs, not going to be deductible. And that is a permanent one as well.
Now, if you are taking money out of your home, and let's say you're going to go buy an investment property, then the trick is to make sure that you're deducting that against that investment income. You don't treat it as a mortgage interest deduction on your personal under your itemized deductions. You would actually write that off on Schedule E on your 1040. So always talk to your accountant. Before we go on, I do want to just say there was the car loan interest deduction that was a temporary provision that I do want to explore just with you quick because I know you know this stuff. What is that, and what does that mean for people?
Well, I think if you look at the car interest, and first of all, what they did with the car interest is temporary, so it expires New Year's Eve of 2028, so you get it through 2028. But the question I get from a lot of clients, in the past was, can I deduct my car interest loan? And the answer is no. You can't do it. You can't do it. And a lot of people would just stop there and not take the next question of, how can I do it? Is there a way I can do it? Is there a loophole? Is there something here I can do? And the answer to that is yes. Even before we get into the new law changes, if your car loan interest was on a business vehicle, the business could deduct the interest. So now we look at, well, can I deduct the interest now? And the answer is maybe, right? Maybe you can. And the rules that are in place now, and it applies this year through 2028, deduct up to $10,000 of annual interest on the loan, on your car loan for a new car, okay, new loan. So it has to be a new car from 2025 through 2028, and any interest that you pay on that. You say, oh, that's great, I can deduct all my interest. And that's when we have to pull back and say, maybe, because we're not talking about business use here. Obviously, you could do that on the business side. You don't need to itemize your deductions, so you can take the standard and still get this, but there's a phase out. And the phase out starts, I believe, at 100K for singles, double that for married couples. And then it phases out completely at 149 or 249,000. So if I make $250,000, I don't get to deduct my car interest, okay, even though I would otherwise qualify for it. If I make 50,000, I do up to 10 grand a year of interest, and that would be that'd be a huge, big car payment if you've got 10,000 of interest in 1 year.
Yeah.
So
And two caveats on this. It's not, I don't think there's a restriction on the vehicle price, but there is a restriction on the vehicle. It has to be a final assembly in the United States. So it has to be a U.S. vehicle. And if you're wondering what that means, think, the parts can come from elsewhere, but it's got to be put together here in the United States. And you'll end up with a list of, here's the cars that qualify and here's that don't. You just have to watch and wait for it. Everybody's going to say, oh yeah, my vehicle qualifies, you should buy it because you can write off the interest. They don't know your situation, so they can't make that statement. What you can say is that this vehicle does qualify if you qualify for the interest deduction.
yeah, I want. That's a really good point there, as far as who can qualify and what have you. But this is something that you need to be really careful of with the internet. Is I was looking, obviously I'm looking at a lot of Kiplinger, all these Wall Street Journal, everybody that is commenting about this and trying to put together, like, what's our plan here. But I went to the one website and they were saying, well, in order to get $10,000 of interest, the car is going to be, $100,000 or something. And so that means that you can deduct, the interest on your Porsche and your Lamborghini and all these other vehicles. And I thought, wow, what, I must have missed something here, because I thought the vehicles had to be assembled in the United States. So then I go back and check, and it's like, yes, they do need to be assembled here. And so, your $100,000 Beamer that's assembled in Germany is not going to qualify here. It's just not. And so be careful what you see on the internet, because after reading that, I thought I could just go out and buy a new BMW and it would qualify. But if you read the
Yeah.
law a little more closely, it doesn't qualify.
And it's interest, not payment. It's just like mortgage, right? Where
That's right.
it's not the principal payment. So, I buy
That's
a
right.
car and I'm paying it off in 6 years. My car payment's X. That's not what actually you're looking at. It's the interest payment. And they'll break it out and send you a notification of what that is. And assuming that you're underneath the exemption amounts, the phase out, then you'll be able to write that off. And again, what Scott said is 100% correct, which is huge. And I want to emphasize it and put a big line underneath it. You do not have to itemize to take this deduction. You get to take this deduction in addition to itemizing. So remember what I just said, with the charitable donation and you're 65 and you have a standard deduction, you're at like 45,000, and you financed a car and you have an extra $5,000 of finance. You throw that on there as well. Now you're not paying tax on the first $50,000 that you're making. It's like literally it's all deduction. And
Yes.
then you start in the lower tax bracket. So this could have a huge amount of tax relief for typical Americans that are, have these high interest loans right now on these autos, and this will be great for the next few years. Again, it ends at the end of 2028. So I think it's going to work if you bought a brand new car that was assembled in the United States in 2025. You're going to get this deduction, but you're going to have to buy that car and put it into service before the end of 2028 to take advantage of this as well.
And again, a lot of these, whether permanent or whether they're going to expire, it's like, what's the economy like in December of 2028, right? I mean, nobody has a clue what's going on, and so this car loan interest could very easily be made permanent. Then it could take on another 5 years. They could eliminate it. There's a lot of different things that are possible. So we need to focus on this year and then in the next couple, and just expect changes again, right? I mean, unfortunately, it's gonna happen.
It's Congress, and
Yes,
we'll see who gets in
yeah,
control.
they're not happy unless they're making us unhappy with a lot of these complicated tax rules. But we'll get through it though.
Right.
A couple other
There's a
things.
few more. Yeah, let's
Yeah,
go.
a couple of other ones, Toby, on this. On the Schedule A deductions, the casualty loss deductions, that was made permanent. So now it's limited to federally declared disaster areas. They also added state declared disaster areas, and so that's something that's new. So, let's say that there's something happens in Colorado here. It's not something that Trump wants to say is a national emergency. Well, maybe the state says this is a disaster area, and we can then get the deduction. But otherwise, not going to be able to do much there. Um, as far as a couple of other points, I want to talk a little bit about. We've been mentioning about the 529 plans, and what those are a very tax efficient way to save for education. And so they made the 529 plan rules permanent, allowing up to now $20,000 of withdrawals every single year from that if it's being used for education expenses. What they included, though, what that was not included before, was a lot of this like workforce training, credentialing, getting yourself, some new designation or something. All of these now qualify as 529 plan expenses. They didn't before. So those are, the as far as the itemized deductions go. As far as the personal taxes go, I want to look too at the alternative minimum tax. So this does not apply necessarily just with your deductions as far as Schedule A goes, but it made the alternative minimum tax, this AMT creature, permanent. And so basically what happens there is that they want to make sure that people pay some tax. And the rate maximum on the AMT remains at 28%. And what I was looking at though is who could be exposed to this, and it can go down to a very low level of income, a little bit over 88,000 if you're single, 137,000 if you're married filing joint. So, if my wife and I make 150,000 this year, we could be subject to the AMT. Doesn't mean we will, probably won't be, but just realize that you don't have to be Warren Buffett before the AMT kicks in, right? You could be, I could be making 90,000 bucks as a single person, and I may get exposure there.
And those were increased under the Tax Cut and Jobs Act, so that if we had not seen those changes, and if we did not see this change in specifically, you would have had a whole bunch of taxpayers caught unawares that they were subject to the alternative minimum tax, which basically excludes your deductions and things like that, and just says, hey, if you wrote off everything, and we just went through a few situations where people are writing off a ton on their standard deduction, and maybe it's the senior deduction and they have the auto. It'll be interesting to see whether the AMT kicks in and sneaks up and bites a few people. So they did increase those limits and they made them permanent. They increased them under the Tax Cut and Jobs Act. I'm not 100% certain whether they just extended it. I believe they probably did, and just said, hey, we're just going to cross out expires in
Yep.
2025 and put a line through it and just said permanent.
Yeah,
Uh,
yeah. So your AMT is permanent as well. And I had one person describe it to me as like your deductions are a write-off and the AMT is a write-on, right? That they're going to take
mhm.
some of your deductions that you deducted,
Back
right,
in.
and took off of your income, and now throw it back on for purposes of AMT. And then the software, the tax professional, will do the taxes the normal way and the AMT way, and whichever one is higher, you'll pay.
Now,
So
we've
something to
been
look at.
talking a lot about the itemized deductions, a lot of things that are gone. We've seen phase outs, we see these caps and things where they're hitting the rich. They did give the rich something that, for those of us who work in the estate planning world, harp on all the time, which is this, these estate taxes. If you watched Yellowstone, I think their final season, that was kind of the punchline. All the estate tax attorneys were like, "Oh my gosh, that's what took them down was the estate tax, the one thing nobody ever thinks about." Um, and that's exactly what Congress addressed. And what did they do on that one, Scott?
Well, they made it permanent, I think, for one thing, which gives us a little bit more planning certainty, especially, I guess,
Mm-hmm.
for estate planners like you, Toby. I don't do that or haven't done it, but basically what it did is it took the state exemption and increased it up to $15 million per person. So a married couple could get, in effect, $30 million of exemptions from the estate tax. So if I look at my balance sheet and all my investments and everything, and it comes out to $3 million or something, and I die, there won't be an estate tax. Is really what that is. And had Congress not done this, and these amounts are indexed for inflation every year, the numbers would have dropped considerably lower. And then we have an issue of, well, if I die this year, I'm going to pay tax, but if it was under the old rules, I wouldn't. So Congress took care of that issue, and and really increased it. They did also leave the gift tax exemption. What you can give every year without filing a gift tax return. That's still at 19,000. That is indexed for inflation. So we may see that as 20,000 or something more next year.
But you
But
get to
big
use,
changes.
if you go above that 19,000, you just use your lifetime exclusion, which there were so many financial planners that were just creating messes all over the place. I'm sorry. I see people saying, well, it's going to come back and, you're such a high net worth person. Let's do this slat and this other thing. And if, we're going to do some asset protection trust, we're going to do some gifting. I get it. But it was always because next year this is going to come back, or we don't know what they're going to do. It could be $1 million or this other. That won't go away, guys. Like, even though they made this permanent, Congress is still going to be bringing this up. It's going to be every other year. You're going to see somebody coming in and making it something where they're going to try to make their bones on hitting the rich. And this is the tax at the end of your life. You've accumulated a bunch of assets. You have a business. You have your house. You have your life insurance. Everything. Throw it all in. If it's over a certain amount, it's getting hit at 40%. And that's just the federal. Plus, you got your state. Some of the states, the exemptions are as low as $1 million if you're in Oregon. In some of the states, they go up to 35%, like if you're in Washington. It's like this. You could end up literally with a 75% tax on certain assets if you're not careful. And that's what this is addressing. So it's a large amount. And a lot of people are like, yeah, my state's not anywhere close to that. You still want to watch it because they keep threatening to take it back to $1 million or below. When I first started practicing, I think it was 600,000. So it could come back. But it is something that they addressed here, and it is something that's relevant, especially if you're wealthy or if you plan on becoming wealthy. Then you better make sure that you don't work your whole lifetime just to have somebody take it from you. There's one last, Scott, and I don't mean to
Mhm.
interrupt you because,
No, it's
again, we'll
fine.
be here. If you let us, if you let Scott and I talk about this stuff all day, we'll be here till midnight. I want to. We haven't even touched the business stuff yet. What about HSAs?
HSAs, health savings accounts. That's one of the things that I think people really miss the boat on. Really miss the boat on there, where you can put what I think it's what triple tax favored, right? You can put the money
Mm-hmm.
in there, you get a tax deduction, you get the tax deferral while it's being invested, and when you pull it out, as long as you use it for health related expenses, it's tax free. So we get this triple tax benefit here, but there's certain qualifications for it. And, I know you and I, Toby, have talked about this quite a bit on some of the videos that we've done, but some of the changes as far as the HSA goes, some of the telehealth provisions that really weren't in place before COVID now come in, so we can use HSA funds for those. Um,
Mm-hmm.
but to me, it's just with I mean, and there are limits as far as how much you can put in every year, and those will be indexed for inflation. But man, it's just to me a great opportunity if you have a certain type of health insurance, a high deductible plan. Um, man, you got to use this.
Yeah, what they did is they expanded it so that certain types of plans that normally wouldn't qualify for to do an HSA, now you can. They're giving a little more breadth to whether or not you can actually participate, and in some cases actually contribute. So some of you folks that I think it's on Medicaid, when you get on Medicaid, you can't contribute, and there are some ways that you could actually do that now. They're a little bit complicated, but there are some doors that are opening. And then certain plans used to just be, you had to have a high deductible plan. Here,
Mhm.
we're going to roll our eyes back. You don't qualify, you don't get to contribute. Now they're adding who can get into the tent. And what Scott says about a triple threat, what it means is I can write off, let's say it's this year, it's $8,300 or thereabouts. um, I can, if I have an HSA, and don't worry, I can be rich in making a ton of money and contribute this. It's $8,300. I get to write that off. Now it grows. I can invest that, make that into $100,000, and as long as I'm using it for health expenses, then I don't have to pay any more tax. So it comes out and it pays anything that I've incurred from the time that I set up that plan. It's so potent. A lot of people think they need to start reimbursing themselves right away. Nope, you can just keep track of your expenses, and in 10 years, write yourself a fat check and not pay any tax on it. So it is a triple threat because it's a deduction, no tax on growth, no tax on income when it comes out. And if you're not using it and you're eligible for it, you're crazy. You really should be.
Absolutely. To me, it's like if I was going to list the top five tax strategies that people are not using, HSA would make that list for sure.
And it's
Just
weird because people will climb over glass to get into a Roth IRA or a Roth 401k
hmm
and pay the tax on the way in, but they have something that's so obvious to them where they get a deduction and it's treated just like a Roth. For the
yeah,
most part, if you're using it for health services, there's no tax. It doesn't make any sense to me.
yeah, no doubt, no doubt. I mean, so a lot of personal changes here.